I'm going to record it just so I can share with them so they can hear some of the things we talk about. So I'm not a huge fan of intros just because I know they can take a lot of time out of a meeting, but I do think it's important everyone sort of has a sense of each other, because hopefully we'll be on multiple calls together. You guys probably know a decent about me, but I'll try and do 20 seconds to see how it goes. So here's what I tell everybody. I'm a former C-level banking executive, 3-time startup founder, and I've done over $800 million in transactions. And actually I've done more than that. I just stopped counting at that number. So
makes sense. It's hard to keep up.
Yeah, my largest deal actually was $210 million. And that one was a fun one. So it was quite a bit. There she is. Let's give her a second to catch up with this. Coming in from the 7 o'clock West Coast, Mrs. Energy herself.
No,
she is. There you go. See, coming in strong.
The life of the party. There she is.
We've only talked once on the phone, and it made my week. I tell you what. Cool. So you go by Kiki then. I want to make sure I'm calling you the right thing.
Yes, Keisha, but people call me Kiki.
Right. So I just wanted to be sure. And by the way, my name is confusing. Patrick is a first name for a lot of people, and so everyone calls me all kinds of things. So I'll answer whatever you want. But okay. Kiki, why don't you?
That Patrick is people call Patrick as first name.
A lot of people use Patrick as a first name. Yeah, believe it or not.
Wow.
Yeah, and so it gets confused. I just had someone I was on a call with just now at 9:30, and they were like, I call you the wrong thing all the time. I'm like, it doesn't matter. I'll just answer. I don't care. Just say whatever you want to say. Kiki, why don't you just tell everybody a little bit about yourself so everyone has a sense of what you're doing?
Yeah, so I am Keisha. I live in North Carolina. I have 2 girls, hubby. I have a background in event planning. So I've been doing that for 14 years. And prior to that, I was a registered nurse. But I'm switching gears after COVID. The event planning industry kind of tanked, and I lost a lot of clients. Yeah. And so I wanted to shift into real estate, which I've always wanted to do. I'm currently a property manager for a Myrtle Beach property for one of my wedding clients. So I'm managing his properties, and then now he's telling his friends about me. So I'm going to be adding on probably 3 more in the next months. And then I met Renee on Clubhouse, and also at an event that we went to, and we learned about.
He knows all about it. Yeah. He knows all about it.
Okay.
That program that I told you, 10,000. Yeah.
So we were in that room and we learned about commercial brokerage, and so wanted to also learn a little bit about that as well. So awesome. Kind of shifting gears, but I'm really excited to be in this masterclass.
That's cool. I can see sort of what you do tying in well to it, right? I can really see it. Help these folks buy new properties, things like that, right? Not just manage their existing ones, but help them buy new properties. So, exactly. Bill, go ahead.
Yeah, I live in Florida, right about, I'd say 15 miles south of St. Augustine.
Oh yeah.
If you know where that is.
Oh yeah. East side.
My background is mechanical engineering. Been in engineering applications for about 40 years, so I'm an old guy. Just kind of got out of that business due to the fact that, like Kiki, all the folks that I dealt with are in the wrong industry, which was coal and other things that people don't want to talk about. They're going to want to talk about it when all the green stuff goes south on them. But the way that goes is I have a lot of experience in projects, industrial and large commercial projects, but mainly industrial. So I've hooked up with a lender that does rather large funding of projects. And what I'm doing, since I'm on the East Coast, I'm running these projects down. And when they get back to me, I hook them up with the folks on the West Coast that are actually funding the project.
Funding them. Okay, cool. Yeah. Awesome. Sounds exciting. Very cool. All right, Miss Dynamo. Introduce yourself to Bill since he's not met you. I know I've had the
Bill, meaning like through the slots. channels potentially. But I know Bill, he was working it because he was like as active. I want to know everybody too. So hey Bill, how you doing? My name is Miss Renee, and I'm just super excited to be in this industry. I came across it by the PPP. So my industry is specifically notary. So I'm the last step, which is the 42nd process of the process. We all sit, big old stack, you're intimidated by us, and we just get you in and out, right? So I help that community, which is notaries, right, to elevate their business. And when the PPP came, I actually didn't know that I stumbled across a commercial brokering opportunity. So I helped $1.3 million go to 153 notaries. And on that, I was able to get 1 basis point, which is 1%, which is $14,000, right? And at that moment, I said, I didn't even really know what it was. They brought me on as a loan originator. And I was like, I don't know, but I just kind of test the process. Fast forward about 5-6 months, I'm hearing in Clubhouse, commercial loan brokering, didn't really understand what it was. But that's when I was like, oh, there's a name for what I just did. Then fast forward 6 months later, they had an in-person event that had like a hybrid model, was able to hear it. I was like, grasp it. Then I met Miss Keisha not too long ago, about 45 days ago. Mm-hmm. And then she came across Patrick course. Somebody shared it with her, saying, hey, if you can't pay for that, you can still get the knowledge through something else. Mm-hmm. So then I was like, who is this guy? Who is this guy? So I literally used my CIA skills and start following him. And I was like, I need to get access to him. Where is he? So I found his little calendar link, and the rest is history. And I just talked his ear off for a whole hour.
God, I love you. Your energy is amazing. Yeah, it was a great conversation. I hope there will be plenty more. So a couple of thoughts out of those introductions. So lots of diverse backgrounds, which is great, right? So I don't want this just to be I want this to be more, opportunity to not just share information or learn from me, but sorry, they're wearing me out about this platform. I'm just going to ignore them. Not just to be about me or the course, but also the opportunity to learn from each other. But I do want to help continue to expand, because it sounds like everybody's in a fairly early stage in this type of business. So what I'm going to do is I want to start today. I want to share something that I find myself sharing pretty consistently. I think Renee has actually heard me share this since we've already had a one-to-one, but I want to reiterate it for you other two.
I need to reiterate it.
and Eddie, who's part of the group, he's just not joined us today. But
that's what I was about to say. I was just about to put in the chat. I was like, he the one that wanted this group to happen. Where the heck is he? Yeah.
Well, people get busy, and we'll try and match people's calendars going forward, but it won't always be perfect. But so one of the things I want to just point you to is I always, when I teach things, I always try and break them down to as basic as possible. It's actually the reason the course was designed the way it is. If you look at some of the questions I get personally, a lot of times people are asking me to go into more advanced concepts. Talk about mezzanine financing, talk about this. And I'm like, okay, if you're new to this, none of that matters right now. You just get really good at the basics. It's the Pareto's principle, the 80-20 rule, right? 20% of the information that makes up 80% of the use cases. That's how I try and teach stuff. So I'm going to tell you 2 things that I think you should get really good at out of the course. You can revisit the videos on them, or we can talk about them here, that I think will change the trajectory of this business. Here's what they are. Number 1, get your pre-screening process down very well. Why? Because if you don't, you're going to find yourself in a situation where you're working on deals that you're not able to get paid for. Right? You're going to spin your wheels on a deal over and over. Now, I'm going to also put a caveat on that statement. I try and be a very good giving person. I try and be. I'm not perfect, but I try and help when I can. So I have, over these years of doing this type of stuff, had plenty of people come to me where I was like, there is no way I'm going to get you funded. They told me they filed bankruptcy yesterday. I'm going to be like, okay, I'm sorry that happened to you, but it's going to be really hard to get you a business loan, right? And so I try and guide them. What I usually will do in those instances is say, you're not ready yet, but if these things occur, here's how you can come back to me later, right? So I try and add value there. But at the same time, you can't spend 15 hours with these people trying to work through a deal, because you're not going to get paid. So the So get these pre-screening questions down. And I'm going to go back over them for a second because watching the video, me do them, and then hearing me here may help you a little bit. So I'm going to cover it pretty briefly and leave us time for other stuff on this call today. So here's one of the first ones I ask. Now, if you've been through the course, or if you've only done part of it, if you've been through the part where I talk about sources of repayment, maybe nod for me if you sort of remember this idea, sources of repayment, okay? By chance, does anyone remember what the primary source of repayment almost always is? It's cash flow, right? The ability to pay the loan back is almost always through debt service coverage ratio, DSCR, cash flow. Now, if that's the primary source of repayment, I try and hit that early on in my introductory call with somebody. So here's what I will say. This is one of my favorite ways to ask this question. And I'm role playing here. If I were to look at your tax returns, not your profit and loss statement out of QuickBooks, what you send to the IRS to tell them, and I don't say this part, what you send to the IRS to tell them how much money you make. Mr. and Mrs. Barr, if I were to look at your tax returns for this year and multiple years going back, would I see you are making money or you are losing money? Right? Now, why does this matter? If they say, well, I'm losing money, but wink, wink, you know why I'm doing that, right? Wink, wink. Why are they doing that on their tax returns? So they don't have to pay taxes on the income, right? They're going to write off everything they can. And I'm not saying that's a illegal or even a bad approach, but here's the problem. When you're trying to prove to a lender that you have the primary source of repayment available to them, cash flow, what do they look at to determine that? Your tax return. And so if your tax return shows losses for year after year after year, how can they feel comfortable you have the cash flow to pay back this loan? So that's the first thing I do. If I were to look at your tax returns, would I see that you are, sometimes I'll say in the black or in the red, right? Because black is positive in tax returns, red is negative. And I have a small accounting background. That's the first thing I ask. So when they say, oh yeah, I'm all good, I go, great, check, primary source of repayment, sounds like it's good. Renee.
Repeat the colors again.
So on a tax return or on accounting statements in general with accountants, they call it being in the black means you're making money. In the red means it's a negative. It happens in Excel. You can actually set up an Excel spreadsheet and tell it to do the red when you're negative. So I'll say, if I were to look at your tax returns, are you in the black or are you in the red? Now they may not know what that means. So I may have to come back and say, are you making money or are you showing a loss? Some will just say I'm showing a loss and they don't say, wink, wink, I'm showing a loss, right? So if I can get a verbal, I'm in the black, the next question will be, that was this year, cool. What about last year? Oh, I was in the black last year too. Now I'm starting to hear it and I'm getting really excited. Check again. Then I might say, is there growth? Meaning this year, did you make more money than you did last year? And if they say yes, I'm really starting to check boxes, right? Because what's a lender looking for? Growth.
Consistency.
Yeah, consistent growth. Now, if it's lost money last year, but made money this year, okay. And I'll talk about that in just a second. So I'm starting to I'm looking for these positives, right? I'm getting a feel for where we are. Now, I've checked off that box or I haven't. They say, oh, I'm in the red for the last 3 years. Then I go, wait, it's gonna be really hard to get a business loan done. That doesn't mean we can't, but it's going to be harder. So then I go to the next point, which is the secondary source of repayment, which is what? It's usually collateral, right? Fixed assets of some sort. Kiki, in your instance, a lot of these property managers, if they're getting loans, they're going to have collateral like that. Your box is already going to be checked. Why? Because they've got real estate.
Mm-hmm.
Now, it's assuming they're willing the lender to put a lien on it, right? You got to get there, but check. I got the secondary source of repayment. It's almost always collateral. Okay. So when I'm doing, these are my two big questions that I think about when I do this pre-screening. There's some others and I'm going to cover them, but these are the two things just get really good at. Search for that primary source of repayment. If I were to look at your tax returns for the last couple of years, am I going to see you making money or losing money? Check. Next question. What sort of collateral do you have that you're, notice this word, willing to give the lender? Oh, I've got equipment. Okay, not bad. Oh, I've got some real estate. Oh, and now I'm really excited. Okay, so I'm checking these boxes. We good on the, yes, ma'am.
For the collateral, does the collateral have to be of an equal value to the property that they're trying to get?
Okay, let's talk about that. So you want to cut. So let me give you a general rule. Remember, I try and teach basics, and so it's not going to be 100% accurate. And maybe over either today or other calls like this that we do, we'll talk about specifics. But I wanted to give everybody a general rule in terms of collateral. Very general, because it depends on the type of collateral. But just want you to get this basic concept: 80%. If I want to borrow, if I have a piece of collateral that is worth $100,000, then generally speaking, I can get $80,000 on that 100. Let me do that again. If I have a fixed asset that's worth $100,000, 80% is 80,000. That means I can borrow 80 against that asset. Why the difference? Because assets don't always hold their value, and the lender likes to control risk, and so they're leaving a buffer. Now, you don't have to memorize this because it sounds like a topic we should probably cover later. But other types of collateral, like even stocks, right? Probably 50% LTV, loan to value. Okay. Investment properties, probably somewhere between 65 and 75%, depending on the lender. So I've done this for a long time, so I've kind of got these generalizations memorized per lender. But just for today, if you can walk away with the idea of 80% in my head, it'll get you a good start. Does that help?
Yes.
Okay. So we've got primary source of repayment checked off. We've got secondary source of repayment checked off. There's another key question I really want to know. If I were to look at your credit report, what challenges am I going to see? None of these, by the way, independently are causing me to tell a borrower, I can't help you. So when you have a big enough network of lenders with different risk appetites, you can usually take riskier folks to these other lenders. I'm just trying to get a feel, how hard am I going to have to work to get this one placed? And if I do take it on, I'm getting rid of lenders that I know not to even bother with. I'm doing that I can do all this, guys, within like 15 minutes, right? Because if they're like, no debt service coverage ratio is going to look good, but I've got collateral, then I know I've got to go toward a lender who likes collateral-based loans, right? If I've got one or two checks there and I talk to them about credit and I've got some challenges, I'm going to have to go to somebody who's willing to do lower credit scores, right? So those three questions, primary source repayment, secondary source repayment, so cash flow questions, collateral questions, credit questions, that'll get you most of the way there in 10 or 15 minute conversation. I'm going to give you one more and then I'm going to stop because I don't want to overload you today. We're going to have lots of opportunities to do these things. Yeah, it's a lot to remember. The other one that I always try and squeeze in is I ask about personal guarantees. If you've done that video, then you'll know what I'm talking about. If not, go watch it. Personal guarantee. Are you, and notice what I say here, are you and any other owner willing to sign a personal guarantee? And that's actually a topic we can talk about for a few minutes here, I think. Why do I ask that? Because most of the time the lender is going to require it. The SBA definitely requires it. So what happens? Okay, three of you are in business together. Okay. And Kiki and I are talking through the loan opportunity, and I say, how many owners are there? Oh, there's three of us. Cool. Are all of you willing to sign a personal guarantee? And maybe you guys have already had this discussion as the owner, so you knew this was coming. And you say, you know what? We talked about it. Bill doesn't really feel good about it. Okay, now I've got a challenge, because depending on the ownership, if Bill owns half the company himself and you two are splitting the other half, now half of the guarantee is gone. So you want to cover this personal guarantee question. Otherwise, you're going to run into situations where you start getting excited about check, and all of a sudden you start working with the lender and they come back and they go, yeah, but the conditions of the pre-approval are personal guarantees. And you go, uh-oh, I didn't cover that. And now I got to go back to them and say, who's willing to do it? And all of a sudden, not picking on you, Bill, just using you as an example, Bill goes, I'm not willing to sign that. Forget it. Y'all are out of luck. Dead deal. Okay.
Now, the personal guarantee, does that also have to do with, or is it totally different? Does it have to do with credit? Because I've heard, like, when you're doing a deal with multiple people, like if one's credit is better, they'll go with that person to sign or to take on the deal. So is that the same thing as a personal guarantee?
It's a little bit different. Hold that thought for just a second, because I'm going to talk about global underwriting, and we'll hit that. But don't let me get away with not answering it. Bill.
Okay.
I'd like to, wasn't there a mention about if there's less than 20% ownership?
Yes. 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 I'll
I'll
comment on it. Again, today I'm trying to not overload too much, but yes. So in general, when you talk about personal guarantees, if they own, I keep saying in general, the reason is back to my concept of teaching. I'm trying to give you just the basics, and then you can fill it in later. In general, anybody with less than 20% equity in the business does not necessarily have to sign a personal guarantee. The lender may want everybody, but they may not. They may not. Okay, so let me, since I said Bill owns 50%, I'm going to switch and say Bill owns 80% of this fake company. You two own the other 20% split, 10 apiece. It could be that the lender says, I'll just take Bill's 80% as a guarantee. I'll take Bill's signature as a guarantee because he owns 80% of the company. Why is that? Because he has way more of the controlling interest. Okay. That does tie into what you asked me, Kiki. So if Bill is financially stout, right, and he owns 80% of the company, then as a lender, I might feel okay with just his. That's why you're hearing those examples. But let's say for some reason Bill owns 80%, he's been misbehaving with his money and has some challenges, and you two only own 10% apiece, but you've been behaving and you look really good, then I might say, well, I want all of you. Now, I'm going to confuse you a little bit, so just try and stay with me on this. Let's flip it. Let's say you two own 40% apiece and Bill's got 20%. Okay. Now I'm gonna flip it and say Renee's been misbehaving with her money. She's been, getting a little flashy out there for some reason. Okay.
Renee.
They may come, might happen. No, I'm just kidding. They may come back. Look, she's like, funny dude. They may come back and say, I just want the two of you and not her.
Oh.
Okay. So what they are looking for, general ideas to grasp. Anybody then less than 20% is not a definitive that they're going to want their guarantee, but they always want as much guarantee as they can get. That's the thing, right? If I can get all three of you, even if one of you maybe is not as stout as the other financially, I'll still go ahead and get you to sign a personal guarantee. Questions about that? I do have another comment to add on it, but I want to pause. Yes, ma'am.
That's what happened. I don't have the best credit. I'll be the first one to tell you that.
It happens.
But I went to the bank and I wanted to see, I was coming across my 2-year mark of my business with Bank of the West.
Okay.
And so I'm in there and I said, hey, what do you have for me? What is the possibility, right? They said, well, if you were 3 years, we can get you to up to $100,000, right? Your business. But your credit score has to be, I think it was like at least 620,
Okay.
they said.
Okay.
40. I was like, well, I'm close to it, but something just happened, right?
Sure.
Then I said, what about a guarantor? But they said, we can't do it because you're not even 3 years. That's a 3-year mark. I said, oh man, so what you got for a 2-year mark? She was like, well, we have like a credit card. You can get a credit card. And I said, okay, cool. Then they said, well, I said, do I need to have a cosigner? Because I don't got that. What's your option? So personal guarantee, I said the same thing. Then they said the exact same thing. The bank trying to work with me. So they was like, okay, well, what is his credit score? And I told him, I said, well, he had an 800, but he got about a 700 because I've been using it, right? Then they was like, okay, well, that's cool. But is he on any of your documents? I said, no.
Yeah.
Not the Secretary of State? I said, no. Then at the end of the day, what they also said was, well, we can see if we can work around this. So he has to be, I said, I don't want you to use mine because this is going to bring everything down, even if you do average. They said, well, we got to tell him that he has to be at least 80% at the time, they said, of the business. So they don't even look at you. And we talk to the underwriters to see if we can push it through because you've been in the business. But the thing about it is they was really trying to help me because I started with them with a DBA. So they were going to look at my DBA for 2 years and not look at my corporation that was filed in the same year because the bank was still open. And so I found out banks can do what they want and they trying to find a way. They can find a way to try to.
Let's unpack that because there's a lot in that. Let's unpack a couple of things. First of all, appetites. Okay. Lenders all have different appetites. If you work hard within your network, you will find lenders that have the type of appetites that fit better with the prospects you're running across. Some will not. And those appetites will change. Why do they change? Maybe they took a loss recently on an identical business that you're bringing them. If that happened, they may go, we don't want to do any of those more right now. So appetites change. Okay. That's the first thing to understand. The second thing to understand out of what she just shared is a good lender that you work with will be somewhat nimble in their underwriting. They won't just say no because of one issue. Okay. So I would have people call me when I was a chief lending officer and they would say, I had a bankruptcy 5 years ago. Does that mean you can't help me? And I would say, not necessarily. Why not? Because that's just one factor. I'm also looking for debt service coverage ratios. I'm also looking for collateral. How have you behaved in those 5 years? Right? All these other factors. So a good lender doesn't just kill a deal. They don't kill the deal just because of one thing. A good lender that you work with is going to say, well, that causes us some challenges, but there could be some mitigating factors, which is just a fancy way of saying things that offset that risk, right? So what were they doing with Renee? They were trying to offset or mitigate that risk by adding someone else whose credit was a little stronger. That's all they were doing. So there's a couple of things to think about there when you're thinking about picking lenders that you work with, and it's going to take you time to understand this. But when you talk to them, you can pre-screen them by asking these types of things. You can say, when you underwrite a deal, do you take a global view of the opportunity? Meaning, do you look at all the factors to determine approval or decline? Or, as a lender, do you have a history of killing the deal over one bad thing? And if so, what are those bad things, right? They may say, well, anything under an 800 credit, I'm not touching it. You run away, go find another lender, by the way, but you get my point. Mm-hmm. So there's a lot to think about in there. Picking lenders based on appetites and their ability to have some flexibility. These, to your point, Renee, these lenders, there is no compliance regulatory thing holding them down as it relates to their own underwriting guidelines. They can set that. If you do your own investing, you have a risk tolerance, right? You have your own risk tolerance. I'm willing to take this much risk, but not this much. Lenders are no different. It's just understanding what that risk tolerance is and then keeping track of it as things ebb and flow. When the Great Recession happened, 2008, 2009, guess what happened to all of their risk tolerance? It plummeted, right? Because they weren't willing to take as much risk anymore. And then things got better and it kind of went up. So when you talk to these lenders, you've got to get a sense of their risk tolerance. This is why I interview them when I choose to work with them. Talk to their team. Tell me about this. What are your underwriting guidelines? Sometimes they'll even send them to you because sometimes they'll have a policy. You say, are you willing to share those with me or at least tell me about them? Oh, I'll do. And in there, all of this ties together. And there may be loan to values that we talked about earlier. They may say, this is how much we'll lend against an asset. These are the unfavorable industries is what we call them. I don't like to do loans to vaping shops because it's a issue for us. All kinds of things. What questions out of those comments? You guys sticking with me? You okay? Mm-hmm. Okay. We doing good? All right.
Just with the questions again.
Yeah.
So you said primary and secondary. Secondary is collateral, primary. But when you talk about DSCR. DS
debt service coverage ratio.
DSCR. Is that primary or that's something totally different?
That is a fancy acronym for cash flow.
So that's number 2, and that's not number
always
1?
Primary. It's always primary. Wow. DSCR is cash flow, which is almost always the primary source of repayment.
Okay, so that's based off of just them having a job, correct?
No. So let's
on your taxes. I mean, well, I'm just saying that's the taxes, correct?
That is a source of cash flow.
Which is the black.
The black, which is making money, right? So
that can be investment property, that can be retirement.
Anything that creates income goes in. So let's talk about that because I know you and I talked about it, but I'll reiterate it here. Okay. if you're making notes, just write down global underwriting. This is what you want to think about, global underwriting. And I'll tell you what I mean by global underwriting. Remember when I said a good lender looks at the whole picture?
Mhm.
When you calculate debt service coverage ratios, all income and all expenses go into that ratio. So let me say that again. When I calculate debt service coverage ratios, all income and all expenses go into that ratio. What does that mean? Renee's got a business. That business produces income. Maybe she's actually, I'm sorry, I'm gonna switch it. I'm gonna use you, Bill, as an example. So Bill mentioned, sorry, I'm confusing this. Let's use Kiki. Kiki, you mentioned you've got a day job doing this stuff with these companies, right? You've got income coming from your day job. Okay.
Mhm.
Then you've got a business that is producing income.
Mhm.
Both of these numbers go together to get your total income. Total income. Now, Kiki has expenses. Maybe I'm going to make it up. She's got a car payment. Okay. And that shows on her credit. She's got a car payment. She's got a business. The business also has some expenses, right?
Mhm.
These two go together. They make all expenses. What we're going to do, by the way, guys, is one of these masterminds is I'm literally going to have you watch me do a debt service coverage ratio calculation is what we're going to do.
Sure.
That's one of the things we're going to do. I think it'll be helpful. So total expenses, total income. Okay. These two go in comparison to one another. Okay. So let's say I took Kiki's day job income and her business income. And let's say I got $2,000 of per month income, just as an example, $2,000 total income. Then I looked at all of her expenses. She's got a car payment and her business has some monthly expenses. Let's say that's $1,000. You guys follow me? 2,000 total income, 1,000 total expenses. What is that debt service coverage ratio? It is a 2. Total income, total expenses. Your debt service coverage ratio is a 2. You're making double the expenses in income.
Nope, didn't get it.
It's okay. All right. Total income, all the sources that she makes money from, even if she had investment properties and it's kicking off income, all this stuff, she's making $2,000, right? Follow me there. Total expenses, she's got a car payment, it's $300, and she's got some business expenses per month, whatever they are, payroll, doesn't matter. That's $1,000 of total expenses. How did I get to 2? Just divided.
Divided 1,000 into 2,000.
Yep. Yep. How did I get to 2? A 2. You follow me there? That help? Okay. Now I'm going to make a comment on that. And I want you to go back and watch that video. It's not that long, but debt service coverage ratio is one of the longer ones. Forget watching me do the calculations. Just listen for the basics. Here's the thing to take away. And then I think we should probably stop with some of this and just open up for maybe lighter discussion because I'm going to overload you guys today. What you want is a 1.25. That is the global standard. You don't have to memorize how to get there today. I'm going to make another comment that I do want you to start to memorize though. A 1.25. What does a 1.25 mean? It means that for every $1 of expense, they are showing $1.25 of income. Let me do it again. For every $1 of expense, they are showing, where do they show it? Tax returns. $1.25 of income. In the example I did for you guys, that 2 we got, what did it mean? It meant for every $1 of expense, they had $2 of income. So if the global standard for debt service coverage ratio is a 1.25, and in my example with Kiki and all her income and all her expenses was a 2, are we checking the box or are we not?
We're not.
No, we are. We're over.
We are?
We're
Oh,
over
you're
it.
over it. I thought you had to be under it. Okay, got
No,
it.
you got to be over. You're right. You got to be over.
Get it together. Get it together.
No, she's fine. This is all new. The bigger the number for debt service coverage ratio, the better.
Okay, the bigger.
What
the
if
better.
I had a 1.5 debt service coverage ratio?
Feel good.
I'm still doing good. I'm not blowing it out, but I'm doing good. What then does a 1 mean? If I got a 1 for debt service coverage ratio, what
You
does that?
almost there, but you ain't there. So we got to figure out how we can. What's your words?
But let's break it down. What does that mean specifically as we talk about income and expenses? It means that for
Your
every
expenses
dollar,
are-
it's
Mhm.
flat, right? They're
Mhm.
covering everything, but that's all they've got. They're just covering everything.
Check by check to check.
Yes, perfect. Now we're getting there. They're just covering everything. Why does the lender not love that? Because if something happens, now they're
You don't have
underwater
the money.
and they
Right.
can't pay back the loan. So why a 1.25? Why $1.25 for every dollar of expense? Because there's a buffer. So that if things start to slip, there's a buffer. So when you got to that 2, they're like, woohoo! They've got
Right.
lots of income for their current expenses. And by the way, that expense number, that total expense included the new loan payment. This is after we factor in the loan payment. Okay. So what do you need to take away from that? When you think about talking to lenders, forget calculating this yourself right now. That's a bit much right now. Forget doing that right now. When you are talking to lenders to work with, what, Mr. and Mrs. Lender, what is the normal debt service coverage ratio you look for? Most will tell you right around what I just told you, 1.25. Okay. And then as you progress in this career, we'll get you used to doing what I call a down and dirty, which is just a quick underwriting. So I can do those now in about 3 minutes when I have the tax returns in front of me. And one day here in the future in the mastermind group, I'll show you guys how I do that. And I promise you, you'll get it. It's once you know where to look on a tax return, I can literally pull the numbers down and say, this is about what it's going to be. Why does that help? And other commercial loan brokers do not do this. They just take a deal, forward it along. They don't calculate this number. Why is that going to help you in the long run in this career? Because when I call the lender, I say, I got a 1.35 debt service coverage ratio I'm about to send you. Now, we all know they're going to verify those numbers, right? They have to. But how does that change the conversation with them? Get a little more interested, don't they? Because they're like, wow, this person knows what they're talking about. And I know this deal's going to look, at least when it comes to the primary source of repayment, it's going to look pretty good. Okay, we've gone about 41 minutes and I've flooded you guys with stuff. Now it's all in, believe it or not, this is all in that course, but I think it helps to do it this way. And we're going to keep doing these types of things in the mastermind group. That's my whole point of doing this, besides giving you guys chances to network a little bit. So I have another topic I can talk about, but I want to pause and make sure you guys are feeling okay about all this, or if you have any other questions on that topic you want to talk about. The next thing I was going to talk about was another recommendation that'll change your business, and it's not as heavy. It's not all these calculations and things like that. Anything you want to ask me about what we've been through so far?
Yeah,
So I have a question about debt service coverage ratio. So for an example, when you're looking for me, like short-term rentals, like if you were looking for a property, because I've heard a lot of people say this. So you can get a debt service coverage ratio loan based on the income, right? That's coming in from the property. So if you have like 6 doors or 6 units,
Yes.
and that amount of money covers the amount for the loan, then they'll approve it.
Yes.
Okay.
So why is that? So I was going to stay away from this, but I'll just say it. And again, over time, these things will stick as you hear me saying more. What they're doing is they're looking at the property itself. So what that is called is the property has to stand alone. What that means is if the property can't cover its own loan payment, why are you buying the property?
Right.
Right. Then the next step is go into that global underwriting. They will take the property and the owners and look at everything together. But the idea is first you want the thing to stand on its own. So that's what they're doing there. You've got 6 doors. Let's do an example here, Kiki. So just spit out a number. How much rent per door?
$1,500.
$1,500. 6 of them, $9,000 coming in per month. Okay. Let's just have some more fun. So $9,000 in income. Okay. Stay with me. $9,000 in income. They've got some expenses and things like that. Let's just riff on that. What's cleaning and all these things add up to? Just give me a number just for fun. all the expenses to keep that thing going.
Including, we'll say $2,000, let's just say.
And that's for all of them, not just per
Yeah,
door.
all
That's
of
all.
them.
Okay, so we got 9,000 in income, 2,000 in expenses. Everybody with me? 9,000 income, 2,000 expenses. So far, without even calculating it, you guys should be able to tell me if we're checking the box on the debt service coverage ratio. We're doing
Yeah,
pretty
we are.
good, right?
Mhm.
We're over a 4.
Yeah.
You see how I did that, right? Because a 4 would be 8,000. We're at 9.
Mm-hmm.
So we're over. Okay, let's keep going. Now they're going to get a loan to buy this property. How much is the property? What's the cost of the property? $1 million? I don't know.
Yeah.
Let's just say $1 million. Okay.
Mm-hmm.
Well, let's just pick a loan payment. So on $1 million, I'm not that good at math that I can do that in the middle of the air, but let's just call it $3,000. $3,000 a month in a payment. Okay. So now what do we have? Start to work through it a little bit in your head. We have 9,000 in income. What did we say all expenses were? Kiki picked 2,000.
Mm-hmm.
Or got a loan payment. What did I say it was?
3,000.
What's the total expenses?
5.
5.
Mm-hmm.
We've got 9 in income. So that's probably somewhere around a 1.75. You can see I did that? 9,000 income, 5,000 in total expenses. Is that property producing a positive DSCR?
Yes.
Pretty positive. It's probably right around 175 or something like that. Just off doing the math in my head. Is a lender going to like that number?
Yes.
Yeah.
So if we check the box,
Mm-hmm.
yep.
1.8.
1.8. I was close. Thank you. You got it. Good job. So you see.
So they look at all 3 factors. They look at everything, even though the building can stand alone. They don't just look at that.
I didn't get that.
So what I'm suggesting is a lender wants you to make smart investments, right?
Mm-hmm.
So what I'm saying there, Renee, is that
What is the 3?
That was just monthly payment of the loan.
Yeah, it was the 3,000 I picked. I was just estimating a loan payment. It's not accurate. It's probably a lot more than that, but let's just assume.
What Kiki was saying that they look at all 3.
Oh, well, I don't know about the 3 number, but what she's suggesting is what the lender is going to look at is first, they're going to see if the building is carrying its own weight. You follow me there, right? You follow me at that point. You just, let's say the property was only producing $1,000 in income, but it had 5,000 in expenses. Would a lender like that? That doesn't make any sense, does it? That's a dumb investment.
So pretty much do the DSCR on the actual building itself.
Or let's do another example on the business.
Mm-hmm.
Is the business carrying its own weight? Then what is the next step? Then they add in income from the owners. Maybe you've got another business. So that's where the global concept comes in. So where we got to on all this was the idea that the thing associated with the loan, I'm buying a property, a business is borrowing money, those should stand on their own. Why would a lender want you to buy a property? I'm going to stick with that example because it's easiest. We all get it. Why would a lender want you to buy a property that's $4,000 underwater every month? That doesn't make any sense. Mm-hmm. Now, if Kiki bought that property and from other sources of income, Kiki's making $50,000 a month. That's global underwriting. I looked at the property. It's not doing that great. That's actually terrible. But Kiki makes a whole bunch of money. Now what just happened to that calculation from a global perspective? Got really good.
Mm-hmm.
So it should stand on its own. But if it doesn't, if an owner through other sources can bring it back up to a positive DSCR, then we're in business.
Okay, got it.
Yep. Bill, you had something, I think. Do you remember?
Yeah. Well, you mentioned that you have to add the cost of the loan.
Yes.
Into the DSCR. I mean, you have to have some kind of idea what the loan's going to cost.
Yes.
Begin, right?
Yes,
So
that's right. So, yep. So what I will
schedules.
do is say, in this instance, I would say, Kiki, you're buying this property. How much are you buying it for? She says, I'm buying it for $1 million. I go, great. I've been doing this for a while, so I know the loan's probably going to be not a 30-year term like you can get on a residential mortgage, but maybe a 15 or a 20. Mm-hmm. I go into a mortgage calculator and I calculate $1 million over 15 years at what I think the going rate's going to be, right? 5%. I estimate it. It comes up to this number. I add it to all expenses, compare it to total income. I have a debt service coverage ratio figured out.
So you can get that either on the internet or you can have a PI business analyst. You're done.
Something like that. Yeah. Sometimes
Right.
I'll just go into like a standard mortgage calculator and just run the number and say,
Sure.
okay, you're buying it for $1 million. I think rates are going to be 5 or 6% on this kind of deal. Just estimating. It's not going to be perfect, but you're just trying to get an idea quickly, right?
Right.
It's going to look like this. Okay, great. Now, if they told me, let's take this back to the beginning. When I look at your tax returns, am I going to see you making money or losing money? And they go, I'm losing money. And I go, great. And then later in the conversation, I go, well, the loan payment on this thing is going to be $5,000. Where's that going to come from? And a lot of times they'll go,
Mhm.
You go, well, we probably need to rethink this.
Yeah.
See how, hopefully it's, again, it's first exposure. Try not to be too daunted by it. We're going to talk about these things over and over and over until you just get them part of your routine. But you see how can you at least see how it starts to tie together in this pre-screening questions I'm running through? And again, I know I've been doing it a long time, so it's easier for me, but I can do this quick. I'm just through it. I'm like, question. There's some chances there. Send me your I'll send you a request for financial documents and my finder fee if they agree to work with me. They sign everything. I start digging into it, right? Or question. Holy cow, they'll never get a loan. Gosh, I'd love to help you, but I don't think you're there yet. Here's what you need to improve on. You need to be making some more money or showing better profit, et cetera, improve your credit, whatever it is. Call me when you're ready. Just kind of trying to figure those things out. I do want to touch on Renee's question. She had one in the chat when I was seeking feedback. So she was asking about, let's see how you phrased it. You said how to build your network, what to say. So let's talk about that in the last 10 minutes we got together today, okay? Because this is ties in exactly to what the other thing I want to cover. So forget everything I've just taught you, revisit your notes, but just set it all aside, clear your brain. Go ahead.
So I meant by that is like one of my friends, she's like the networking goat. Let's just say that.
Yes.
So I said, hey, this is what I'm doing because, I have a little bit of a success story with the PPP. So
Absolutely.
she was like, oh yeah, let me just, call some people that may need some money, right? Because I just took out a cash advance. So I kind of know that process a little bit from just my business.
Okay.
And so I was like, well, I can do that at the minimum, right? If people are looking, but maybe that's not the best. So she did a couple calls. She passed me along her uncle. I've been sitting on that for a whole week and a half.
Let's call him together then. So one of the things I'll offer to you guys, if you guys have leads, let me cover this. Yeah. Let me clarify this a little bit though. I'd like you to at least have preliminary discussion. You don't have to take it too far, right? Because I know you may get confused on the call. What I'm getting at, Renee, is I just want you to have a sense of what he's looking for. If he's looking for something that just isn't going to make.
She did not know. She was just like, just made a call.
So maybe just
like, what can you offer? Like, you didn't ask me, that's going to be those questions. I don't even know what is out there. That's okay. A little bit.
So here's what I want you guys to do. So what to say? So a couple things in all of this. First of all, this is the other thing I did want to talk about. Here's the superpower. Superpower number one was getting your pre-screening process down. That's your first, start figuring that out. Superpower number two is building a network so that leads come to you. I was telling Barry the other day in a one-to-one that we had that's in the group. I told him my last couple of years as a commercial lender, I didn't do any prospecting. You want to know why? Because everybody called me for money. Because I was the networking goat in my area, to use Renee's term. So all the accountants and all the attorneys and all the financial planners in town, when their customers said a word about borrowing money for a business or an investment, a commercial investment, guess who got the phone call? This guy. Now, it took me time to build that reputation. So your superpower number two is build a network. Write this down with people who have the customers you want. What do I mean? Why were attorneys so good for me? Because they're already working with small businesses. Why are accountants good for me? Who do you hit? If some of them are doing personal tax returns, I get it. But why are accounting firms so good to build a network with? Because they're already working with small businesses. And what do they talk to about their accountant? Are you going to grow this year? Yeah, I am. You going to need money? Yeah, I am. Call Renee. I've worked with Renee before. Call her. She'll help you find money. So superpower number two, build your network. And it's really simple. What do you say to them? Who do you know? Who do you know? It's my favorite term. Who do you know that needs to borrow money for their business to grow. Don't overcomplicate it. I do this. I can do it this fast. I can do this. I got this person. Nope. Who do you know that needs to borrow money for their business? I can help with that. That's all you need to get down. I promise you. Sounds simplistic. This is the truth. They just need to know that you specialize in helping people get money. And so when they have people that need money, they should call you. Now, you should scratch their back too when you can. If you're saying that to an accountant and one day you have a customer and they go, I hate my accountant, what do? Cool. I have an accountant that I've worked with before and they're amazing. You scratch their back. So what would happen is I would send all these referrals to attorneys and accountants that had never even worked with me. And all of a sudden, what do you think's happening? They're feeling a little bit obligated, aren't they? And they'd say, you should call Jonathan because he can help you. So, with Renee's example about the lady's uncle or whatever, don't even start out with, I can do all this stuff for you. It's a quick phone call. I got your name from so-and-so, right? I got your name from so-and-so. She thought I could help you. Why am I saying that? Social proof. I got your name from so-and-so. She thought I could help you. And here's what I do. I help business owners get capital to grow. Now, Renee, in your instance, what I'm going to recommend, back on my comment about jumping on calls with you guys to try and help, I obviously can't do it all the time from my schedule, but what I can do is help you some, right? No, you're fine.
I help business owners.
I help small business owners get the money they need to grow. I got your name from so-and-so. She thought I could help you. I help small business owners get the money they need to grow their business. And then you ask a question. What is it you're looking for? And he's going to say, I want to start a new business. I want to buy a piece of property. I need a car for my business. I need a new piece of equipment. I need this, this. One of the first lessons in the course is on purpose. What you just did by saying, what is it you're looking to do? You're finding their purpose for that money. And then what do I go into? So I'm going to do it again. Hey, just giving you a call. I got your name from so-and-so. They thought I could help you. I help small business owners get the capital they need to grow, or funding, or whatever word you want to insert. Money. I help them get the money they need to grow. What is it you're looking for? And then don't say a thing. They're going to tell you. What did I just say? I want a piece of equipment. I got an investment property I want to buy. I got an event center. Kiki, I got an event center. I just need it. I want to buy this event center. Okay. As soon as they say that, then you just jump in your pre-screening questions. Great. I'm going to ask you a couple questions to get a sense of where you are as a business owner. Y'all follow me? Let me do it again. But no, because I don't want to give you too much more. I want you to go right there. Go ahead.
The pre-screening questions, just go with the pre-screening questions.
Yeah. Yeah. The ones we talked about earlier.
Yeah, I want to use them.
Or you want me to keep doing them again?
Just the whole flow.
Okay, the whole flow. I got your name from so-and-so. They thought I could help you. I help small business owners get the capital they need to grow. What is it you're looking for? All right, Renee, play with me. What are you looking for? Make something up.
I want a vehicle. I'm tired of running around as a notary.
You want to be able to use a vehicle loan to get deductions on your tax return, all this stuff. That's cool. Great. Let me ask you a couple questions to get a sense of if I can help you. Okay. If I were to look at your business tax returns, would I see that you're making money or losing money? I don't think we don't have time to go through that whole thing, but let's say, go ahead.
I'm making just a little bit of money.
You're making a little bit of money. Okay, great. We call it being in the black. You're making a little bit of money. That's cool. Now, last year, did it look like that, Renee?
Yes, last year's 2021, I was in the black, but in 2020, I was in the red.
Okay. So 2020 in the red, 2021 in the black, and this year you're in the black. Great. The lenders I work with, they do a global underwriting perspective, so they're going to look at the averages of all those years. Right? Remember global underwriting, all income, all sources, over 3 years, they're going to average it up. Cool. So you're in the black. That's great. Do you have any collateral you're willing to give them?
What do you mean by that? Like,
It'd be
are you
some
saying
sort of
like,
asset, some sort of thing that they could put a lien on to secure the loan.
yeah, I have a house.
Okay. And what about the car you're going to buy? Can we use that?
The car I already have.
Well, no, you told me you wanted to buy an auto for your business. Can
Okay.
we use that car as collateral?
The current car you're going to help me get me.
Yeah. You feel okay about that?
Oh, I didn't know you can.
Yes, I can. And matter of fact, I may not need anything else. I may just need that car.
The car you don't help me get a loan to get.
When I'm going to help you buy. Yep.
Okay.
Yep. Okay. Now, what did I do, guys? Check on debt service coverage ratio. Check on collateral.
Mhm.
Cool. What was next? Credit, right? So if I look at your credit, am I going to see any challenges I need to be aware of? Things like foreclosures, recent bankruptcies, late payments, things like that.
You said bankruptcy what?
Bankruptcies and foreclosures, big stuff, right? So when the bank or the lender has to take back a house. Are you guys all tracking with me?
Yeah.
Okay. So we're running out of time and I got to jump, but so you follow me, right? We went through that whole thing. I'm going to share the recording of this once it downloads. You guys can watch this part again, okay? But we went through the whole thing. She says, I'm just going to do it for role playing. She says, no, my credit's fine. It's not stellar, but you're not going to see any crazy stuff. Okay, great. Check. What was number 4? Are you willing to sign a personal guarantee? And let's assume I explain what that means to her. That means that if the business can't make the payment, the lender can ask you to make the payment. That's what that means, by the way, guys. If the business doesn't make the payment, they can ask the guarantor to make the payment. And she says, yes, I'll sign a personal guarantee. Perfect. Check, 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 check. Then I will say, there's no guarantees. We just had a quick conversation and I haven't seen any of your documents, but based on what you're telling me today, it sounds like you've got the opportunity to get approved. Why did I say it that way? Because they could send me their tax returns and the losses are ugly and they lied to me about their credit and all kinds of stuff happens. People are people, right? But based on what you've told me today, everything sounds pretty positive. I think we've got the opportunity that I can help you. And then what do? If they say, great, let's move forward, I email them a finder's agreement and my document checklist that is in the course. Here are the things I need from you to go get this loan. That's it. Then you get it all together, send it to the lender of preference, see if you get approved or not.
Binder agreement?
The broker's agreement. So there's a sample agreement on getting paid.
It said a little bit different. It says referral agreement.
The referral agreement, I think, is set up so you can send to accountants and attorneys. There's one that's actually your finder's fee agreement so that the borrower themselves make sure that you get paid. Remember that 1% you got? This is to make sure you get paid if the lender won't pay you.
Meaning I send it to
The borrower, always for the borrower, always for the borrower. If the lender won't pay you, you want this in place so you can make sure you get paid.
Oh, you recommend a broker agreement?
Yes, because if the lender won't pay you, some lenders won't pay brokers. You have to collect it from the borrower. You want this agreement in place.
And what was the other document I need to send?
The document checklist. So it's a checklist that's in the course of the types of documents you're going to need from them to be able to take it to the lender. Now, how do other brokers do this where you're going to be different? Promise me you guys are going to do this. Other brokers don't get the documents. They say, I'm going to connect you with the lender and you're going to send them over. Then why does a borrower need you if that's going to happen?
Right. They'll cut you off the deal.
Be different. Add value. Take the deal to the lender. The other reason you're asking for those documents is when you get good at this, you're going to look at them yourself and know whether it can get approved or not.
Will pay your fee.
Be different.
That's what I needed.
Okay.
So how do you come into the mix? Meaning I have all of that. Do I still bring you on the call when I'm trying to?
You want my help? Yes. So back to what we were talking about with the uncle. I'd like for you guys, I'll help you with some of your early calls. I've offered to do this with Barry too. What I'd like you guys to do is at least get a feel for what's going on. So maybe call the uncle and just run through that process of, I'm calling you. She thought I could help. Here's what I do. What are you looking for? If he tries to go into the weeds about the deal, you go, right now, I just want to get a sense of if I can help you. Ask your pre-screening questions. and then call me. And then when we go into the details of what the deal might look like, I'll do all that with you. So Barry's got a really big deal. It's like multiple millions. And he's like, I've never done this. I don't know. And I'm like, cool, let me know. And I'll come on the call with you if it fits my schedule. And you can see me work through it.
Well, after he get everything?
I've asked him to kind of get a general sense of what the deal looks like, do the best he can, ask these questions and things, and then let me know and we'll talk it through. And if it sounds like it's got an opportunity to go to the next stage, I'll get on that call with him and go through this, and he can watch me.
How soon do you think that next stage should be on average? If I could have just did a timeline, what is the average?
I mean, sometimes you could call the uncle today and get through these pre-screening questions and get pretty good answers. And, the next day you're having a more in-depth conversation.
But what is usually the turnaround on average? Just averaging it.
For what part? Approval of a loan?
Pre-screening to just like,
oh man,
I'm on the phone with you.
Yeah. It could be days. It could be one day to the next, depending on my calendar, right? It just depends on what you. Now, if the uncle, Renee, if you're talking to the uncle and you're like, he's not even in business yet, and he tells you he's got a whole bunch of credit problems and there's no collateral, should I jump on the phone with him? Probably not, and neither should you. Really, you should go, listen, glad to connect with you. It just doesn't sound like something I think I can place at this time. Time for me to move on. All right, we've got another one in 2 weeks, but you've got the Slack channel to ask me other questions.
I know it's up, baby. Now that Slack, it got moved. It was a little dry, but now it's good.
Yeah, it is good. What you guys ask me questions, just communicate. And the biggest thing I would say is don't be afraid of messing this up. Sometimes it's just okay to say, hey, I'm kind of new to this, so just bear with me. But what you can say is, but I know a guy who's been doing it for a really long time and he's teaching me. Right. So I encourage a lot of the students to tell people, if they're like, how many deals have you done? Say, I haven't done one yet, but actually I'm part of a network that's done over $800 million in deals, because you're in my network and I can walk through these deals with you even. Got it?
Cool.
We good?
Got it.
Was that valuable, at least
Absolutely.
of an hour?
Yeah, absolutely.
Yeah.
Thank
Okay.
you.
Worth
All right.
every minute of it.
Yeah. All right. I'll get the next one on the books. Say again.
Only, correct?
Say again.
Twice a month, correct?
Twice a month. Yeah. Yeah. If we need more, we'll look at it, but I wanted to keep it affordable. Again, everything I do with you guys, I'm trying to keep it where it's not just nickel and diming you to death, but also don't, I want it to be worth my time too. So I tried to keep this reasonable.
I'm just happy we got it, baby. That's all. I'm happy we got it. So
you helped. I appreciate it. Okay. So let me know what questions you have. Just get the basics. Don't get overwhelmed. Okay. We'll talk again soon.
All right. Thank you.
See
Take
ya.
care. Have a good day,
You too.
guys.